of which we have allocation from Rampia coal block. So it is a significant value driver for the business going forward. In conclusion, we are making a significant progress towards our aim of delivering 11,470 megawatt by end of 2014, and I'm confident that we'll be able to meet this objective. We're also making progress with our coal clearances. One of the key issues of all the coal power projects in India is the receipt of forestry clearance from Ministry of Environment and Forest. To expedite the matter, the Prime Minister's office formed an expert group of ministers to review all projects needing this clearance and advance those that are showing significant progress with their construction and development. Both our Mahan and Tori projects have now been reviewed by this committee, and we believe that the progress has been viewed positively, which should pave way for us to receive forest clearances in next few months. We have applied for temporary coal linkages for both the projects, as this will be needed while our coal mines ramp up and to cover any potential delays. But again, given the positive progress with our power project, we expect these linkages to be resolved favorably. Development of Aries coal mine in Indonesia is also progressing through the approval stage and will have to source coal through our contract with SR Shipping while our captive mines ramp up to the full capacity. Now I move to the E&P business. One of the significant developments during the half year has been the allocation to us of 4 CBM blocks by the Government of India. Now we have one of the largest CBM acreages in India, and our total resource base in upstream segment of the business has moved to 2.1 billion barrels of oil equivalent. The development of Ranigaj project is critical to be able to prove our ability to successfully develop these assets. I am pleased to report that the project is progressing to plan. We are currently producing 18,000 cubic meter of gas per day from 15 test wells, and this continues to increase as wells are progressively dewatered. We also drilled 9 more wells in this block and expect to start commercial production by the end of this year. The full field development plan envisages the drilling of 500 wells in the next 3 years, and this is currently under review with the Director General of Hydrocarbons of Government of India. Moving to the refinery. The Phase 1 expansion to increase the capacity to 18 million tons and complexity to 11.8 is now 62% complete. We are still aiming to reach mechanical completion by March 11, but the 2 of the main units are running around 3 months behind schedule. We are looking at ways to bring the units back on the track, but in any event should be producing from expanded refinery within the next 12 months. The expansion would result in a significant uplift to our GRM as our higher complexity will allow us to process a heavier crude mix and produce a higher portion of middle and light distillates. This gives a bird's eye view of the expansion site, which shows the advanced stage of construction of pipe racks and installation of the pipes in progress. On that positive note, now I will hand back you to Prashant.
Thank you, Naresh. I would like to finish today's presentation with a couple of comments on the economic outlook of India, followed by a reaffirmation of our strategy, and then outline some of the priorities for the business over the next several periods. As you will know, the Indian economy showed a lot of resilience last year, despite the significant slowdown in the global economy. GDP fell to only 6.7% for 2009. The last quarter of 2009, however, and the first quarter of this year has seen a significant uptick, and we now see GDP growth back to the pre-crisis levels. Q1 was 8.6%. This has been driven by a sharp acceleration in investment, demand, triggering double-digit industrial growth. Industrial growth will be critical to India maintaining GDP growth rates in the 8 to 9% range as the service sector matures and the country continues to urbanize and industrialize. Of course, critical to this growth will be increasing supplies of power and energy and the key sectors that Essar Energy is involved in. By 2015, India is expected to be the fourth largest economy in the world on a purchasing power parity basis, overtaking Japan, and will contribute 6.3% to global GDP, up from 5.1% last year. Key to maintaining this growth trajectory will be investment in infrastructure, and we expect government spending in this area to be around $1.3 trillion between now and the end of the 12th plan, which is likely to account for about 10% of GDP from around 6% of GDP today. These tremendous growth prospects are why our strategy is and will remain focused on the Indian power and energy markets. Our strategy is to create a low-cost integrated energy company positioned to capitalize on India's rapidly growing energy demand. This will be underpinned by our world-class Vadina refinery, our significant portfolio of greenfield and brownfield power generation projects, and the commercialization of our upstream E&P portfolio. This does not mean that we won't look at assets outside of India, but it will only be where it supports our core strategy and delivers value to the shareholders. And we are committed to having more than 90% of our assets in India, with only the exception to this being in the upstream portfolio of our business, both E&P and coal, where India lacks the natural resources to keep this limit. So when we look at assets outside of India, first, to secure raw materials, either for direct input to our assets, such as our coal assets in Indonesia and Mozambique, or as a natural hedge for our raw material inputs, such as our upstream E&P assets that provide a natural hedge for our crude oil requirements into the Vadina refinery. As you know, India doesn't have sufficient natural resources, and so it is critical to our success that we look outside of the country to secure our raw materials. Second, we will look at midstream or downstream assets outside of India, where this helps to secure market outlets for our product from Vadinar and improve our gross realization. For example, once the Vadinar Phase 1 refinery expansion is complete, we will produce a significant proportion of very high-value products for the export market. At present, we sell these to intermediaries, who themselves collect a margin when they sell to their terminal markets. If we own storage, distribution, or even refining in some of these markets, then we could get closer to our end customer and enhance our product realization. Third, we look at power generation opportunities in emerging markets, where we can leverage our skills and get risk-adjusted returns at levels similar to or in excess of those we can achieve in India. We want to be clear with our stakeholders on the type of opportunities that we would look at. But again, the focus is and will remain on India and the delivery of the projects that we have outlined at the time of the IPO. So, given our strategy, what are the opportunities for Essar? On the power side, it is to complete, to time and cost, our existing portfolio of opportunities under construction and development. This includes both Phase 1 and Phase 2 projects and the associated coal mines, both in India and overseas, together with the interim coal supplies. I hope you will agree that we have made a lot of progress in these areas, and in particular, our Phase 2 projects are coming a lot closer to fruition. But there is still a great deal of work to do to achieve 11,500 megawatts of operating generation capacity by the end of 2014. Beyond this, we are actively looking to secure additional coal supplies, both internationally and in India, and we are actively looking for new power opportunities. In the exploration and production, we have a leading coal bed methane portfolio, and the key to generating value here will be to move Raniganj to commercial operation by the end of this year, and then prove up and commercialize some of our further coal bed methane blocks to move them into the contingent resource category. Although we are not now forecasting a date of signature, it is still a priority to sign the Ratna production sharing contract and move that project into development. As it is also a priority to move forward with the development of our offshore blocks in Nigeria